thinks that she's the lady that needs no introduction, but we do have some new members and some guests, so I think Mary deserves a little short intro. So Mary is the head of Global Investment Research at Heitman, a global real estate investment management firm, which as of September of last year had $53 billion in assets under management. So when we say that she's an economic powerhouse, we know that this is backed up by some serious numbers. She's a partner at the firm and sits on their global management, investment, and valuation committees. She also serves as the global trustee of the Urban Land Institute and is a member of ULI's Chicago District Council. But that's not why she's here. She's here because she is an Ely chapter member. So we are so grateful that Mary gives of her time. As I said, she's been bookended on either side today. And so let's give Mary the warmest Ely welcome.
I'll be truthful with you. I've presented about 10 times in the last 2 weeks. And the deck that I've got for you, I don't even know where the clicker is. Here it is. The deck I've got for you is cobbled together from those various presentations. Some of which were done with a script and a teleprompter. So you're going to get to watch my brain try to dredge up the relevant facts without reading them on a screen. How about that? Oh good, we're going the right way. Some of you were here for the famous SlideGate experience when my slides didn't come through well. I'm not going to even look at them. Well, maybe I will. They look pretty good. They're not as bad as that one year. So my theme today is change. We're in the midst of it, whether we like it or not. We're in the midst of economic change. I don't know about the presentation the gentleman had this morning. I'm not going to focus as much on the economy as I am on other things, like property market dynamics and pricing and development and interest rates and climate change. But we are in the midst of remarkable amounts of change. That's been the hallmark of my career, pivoting, making something good out of bad, trying to learn from the change. That's what researchers do, and that's what I do. But I'm going to talk a bit about change today. So let me get to it, because we leave this room. I need to be done by 1-ish, so that we're out of the room by 1:20-ish. Is that right, Lindsay? Oh, we have till 2:30. I don't have till 2:30. I have a 3:15 flight, so giddy up, right? So behind me are some little icons that are what I've been talking with clients about. The origin of this particular presentation came from a client that said, get beyond the current morass and look out 5 to 7 years so that we can structure our portfolio in a way that is going to be catching those trends. And so colleagues and I put this together. So the first of them is deglobalization. This comes after basically our lives have been spent in a period of globalization, particularly the offshoring of manufacturing, but there's also been services and trade that have gone offshore as well. Well, it's not ending completely, but it became clear during COVID that our supply chains were too long. We were vulnerable to all sorts of things, including a disease that could shut down production capability for months on end. We've gotten used to things being ready for delivery on demand. We still somewhat expect that and then get mad when it doesn't happen. But the COVID era was a wake-up call for many countries, many firms, that have started thinking about what to do to deglobalize their network. By no means does that mean all manufacturing is returning to the US. Likely going to be the higher value manufacturing that comes back. Some of it will come to Canada, some of it will come to Mexico. There'll be an era of more regionalization than we've seen in recent years. But for sure, there are going to be real estate implications of manufacturing returning closer to home. And with that, some of the ports, for instance, the ports of LA, Long Beach, may see lesser levels of demand because things that are produced in India or in Vietnam are likely coming through the Suez Canal and maybe coming to the US and the East Coast ports. So there will be change, there'll be winners, there'll be losers, but be ready for it. If you're not interested in investing in manufacturing or distribution, there are other ways to participate in the growth of Mexico, for example, and that can include housing and retail and other strategies. The next up, bottom left. Migration patterns are driving a lot of real estate investment. They always have. And we've got two doozies of migration dynamics that are underway right now. First up, my generation is the baby boomers. That was pretty clear. I didn't even have to tell you what I am. Not a Karen, but a baby boomer. Baby boomers are largely empty nesters, not those of us that adopted at a really late age, but others are, or are preparing to be empty nesters, and they're thinking about what's round 2 or round 3 or round 4, and therefore some of them are footloose. They're maybe moving to some place that isn't where they end up. We know that the greatest predictor of where somebody is going to spend their final golden years is their daughter's zip code. Nonetheless, there are people that are all over the place and in motion. Second, we've got the millennial generation, the eldest of whom are in their early to mid 40s right now. They'd like to own homes. They are stymied by an array of challenges, including student loans, the run-up in home values, it's only coming off the boil a bit, as well as the remarkably high interest rates. Not as high as when Goodman's Williams Group, not as high as when I was first looking at real estate in the early 80s, but definitely high relative to recent dynamics. And that is making it more difficult for the millennials to buy their homes, and that's creating demand for new styles of real estate, including single-family homes for rent, which I'm happy to talk about. Upper right, climate change. I'm going to conclude my remarks on this, but it has been an area my firm has looked at for the last decade, I'm going to say, and it continues to expand in its reach. So a lot of what I'm going to talk about relates to the regulatory side of climate change, as well as, of course, to the ongoing event risk and catastrophes that we have lived through. And then finally, if you're in a real estate investment advisor like I am, you're thinking about what should your portfolio look like, given all of these various dynamics. And so those little buckets of beads are trying to indicate that there's a change out there. Office was a darling property type for decades. Institutions owned it in part because there were often really long-term leases that were thought to match up nicely with the liabilities that pension plans and other institutions need to pay. Well, what the last couple of years have shown is that office isn't the secure property type that it once was. There are great opportunities in that. There's going to be some great loss in that as well. Retail was the GOAT, not greatest of all time, but the GOAT as in negatively viewed for years now, coming back, and that'll be one of the things I get to in a couple of minutes. Nonetheless, it means that what my investors are buying is a lot different than what they were buying when I started my career in the early 1990s. So let's get into this. Hard for me to see this. I might go, how about that? All right, so we're in an interesting period. It's not clear that we're in a recession. The globe is, and parts of the globe are in recession, led by Europe. That's had a shooting war. It's had a horrible experience with COVID. So issues there. Within the US, we're experiencing, I put it over on the right in the green, what may be a job-full recession. There are layoffs. What did Microsoft announce today? Was it 25,000, 15,000? It was a big number. And there's certainly been other tech companies that have been announcing layoffs. But others continue to hire. And it's possible that that continues through a recession. At the beginning of my career, I thought, wow, I'm going to learn from this recession and then I'll know things. Well, it turns out every recession of my life, and there have been a lot of them, have looked different. And if you think that COVID recession is a recession, start over. This is not your field. Because that was such an odd time. With that much money sloshing around for people to spend, that much government support, I don't think we're going to see that again in our lifetimes. So don't count on the behaviors we saw during COVID continuing, including the click and collect kind of things that were going on. So we're in the midst of trying to prepare for the implications of high inflation and high interest rates. What we know is that inflation is starting to come down, but the Fed seems committed to continue hiking its interest rates. Probably not going to go to 5.25, which was what some were thinking would be the terminal rate, the federal funds rate when they ended. Could be the high 4s, but if you add a spread onto that and you look at the yields for real estate, you know that we need repricing, and that's been underway already, and there's more repricing to come across both in favor sectors and out of favor sectors. I'll repeat, bottom left, my point there, the fiscal and monetary stimulus that we saw in the COVID recession, very few places are in position to be able to do that. Again, China is the exception, and as they've moved away from zero COVID and are coming out into the world with consequences, both positive and negative, expect that they're going to stimulate their economy like crazy. And that could be positive for the global economy. And I should probably put that on the plus side of this. On the upside, broadly, as I said, inflation looks to have peaked. Job flow, I've already talked about that. Oh, I'm going to stop on the bottom right with the idea, this isn't the first rodeo for many of the real estate investors that are in this room or that I deal with within our pool of clients. And that means their expectations for what happens in a recession are so much more evolved than they were during my first professional recession of 90-91, which was when real estate disappointed like crazy and investors sold out of their ownings in real estate at discounts to really depressed net asset values. We don't see that kind of dumping of properties anymore, and what we also see is, well, we know there'll be pain if indeed this is a recession and we see operating fundamentals diminish for real estate combined with repricing, that's going to have some impacts. But what we also know is that real estate investors know that as hard as it is on their existing portfolio, there are investment opportunities that come from somebody else's distress. And so they're ready to jump in. Some of them are upping their allocations to be able to be positioned to do that because they know that they'll never have a better buying opportunity than at the moment where the knife is still full. All right, next, I'm not going to go through much of this because we don't have time, but we're having fun with fruit here. So there are some parallels between the current recession, or what we think is coming, and the global financial crisis. So that's the apples to apples comparison on the left. And then there are going to be some ways that it's going to diverge. The parallels, every sector will be affected. It's already happening. The repricing is occurring across in-favor sectors like logistics and out-of-favor sectors like office, and that will continue. There will be darlings visible for a while. There will be distressed sales. We're already seeing it. The Board of Trade has gone back to the lender as just one local example. I'm going to jump to the right and say the new stars in the institutional landscape are logistics or industrial and apartments. They'll be in demand. People will buy those early. They know that you can adjust your rents to keep your buildings full in apartments, although sometimes those are big adjustments, but you can figure that out. And industrial, there will be some buildings that deliver speculative construction that delivers and sits empty for 2 years, my prediction. But most of the buildings that are out there are going to benefit from the fact that the spread between our in-place leases in Southern California warehouse right now and the market lease is 60%. 60%. So we know that even as demand diminishes, we're likely rolling up to something higher. So there are some good things that have come out of the boom in logistics. So those are likely going to be sectors that look good coming out of our downturn. And the alternative sectors like storage, medical office, student housing, senior housing, they should do relatively well because their demand drivers, their occupant demand drivers are just not as linked to the macro economy. Those were not meaningful parts of investor portfolios 20, 30 years ago. They are now, and that should help my clients ride through the downturn. This is more for, I'll send my slides to whomever should distribute them, because this is just too much to chew on. But I've now lived through a bunch of recessions, and we tried to look at the peak to trough decline in value. This is of institutional portfolios, may not quite line up with what you know. But we looked at them across multiple recessions. So starting with the savings and loan crisis, that's the far left column, or sorry, one in from the far left. And then dot-com bust of 2001 and 2, the global financial crisis of 07 to 09, that should say. We've got two things you probably don't care about, the European sovereign wealth crisis, and then the UK Brexit recession, and then on the far right, the COVID downturn. So the takeaways here are that Property types have varied in their experience to some extent. A few of them, like residential, have done better more often than not. And the residential there we're talking about is for rent residential, also known as apartments. Retail, modest decline in my first recession. And that gave it a little oomph going forward as long leases protected investors. And it did pretty well in the dot-com downturn. This is the purple row. Had a dreadful global financial crisis and was on the outs after that. Office, it's generally challenged by downturns, often because they come after a period of development, so buildings are delivering into a lack of tenant demand. And don't pay attention to the just 0.1% decline during the COVID recession. That's not done yet, that's for sure. Office is going through a major period of repricing. And then finally, industrial. It's generally done well during downturns, but look at the global financial crisis. It was down almost as much as the other property types then, and that related to overbuilding going in. So there are a lot of factors that shape how a property type is going to perform, and that includes just how much development is in the pipeline when the recession hits. Another thing for you to look at in your fun time at home, but I'm looking at net operating income by property type starting in the year 2000 to be able to capture the dot-com bust, which is when things go below zero, led by that green is apartments. It was a terrible downturn initially for apartments. Came out of it nicely, but again, you can adjust your rents, but when people are moving home or they had a job and then they didn't, then it can be a difficult time. The value of apartments is they tend to come out of recessions first. They also, other sectors that do that include the orange on the far right, that arcing up, that's self-storage. And self-storage never misses a recession, it just doesn't stay in recession very long. So we've put it into our portfolios. As you're thinking about what to do with office, and you're thinking about a mixed-use conversion, put some storage into it because it tends to be a bit of ballast in a portfolio. So the takeaway from this complicated chart is each recession's played out a little differently depending on the property type and how much new supply was going in, what happened to demand on the tenant side. The other dynamic is that, generally speaking, we're in pretty good shape right now. NOI's running at really high rates. That's a plus 20% net operating income growth for storage, with apartments right behind that. Yes, they're all peaking and coming down, but not a bad place to start. It is the case that repricing is occurring, so just look at the yellow line, and basically we're looking at Green Street data. They're a really good real estate research firm, and they think that real estate values are off 10 to 15% thus far, as yields have, and buyers and sellers have stopped talking. They're trying to infer what's happened. If you think real estate interest rates are going higher, then we got to conclude that there's more pain to come, more repricing. The other dynamic that's out there is that investors are increasingly aware of how real estate has performed over time, and they're using it to make their investment decisions. They're looking at things such as what we're showing on the left, which is how does net operating income change as GDP goes up or down. The top left, those are the traditional sectors. They're quite sensitive. Their demand drives from the macro economy. They're pretty sensitive to a movement in GDP up or down. By contrast, alternatives like senior housing, shown in the turquoise, self-storage, student housing, manufactured housing, they tend to be a little more moved by demographics than they are moved by the macro. The chart on the right is all about what it takes to keep a building full. And this has been part of the movement out of office. So the traditional property types, we're looking at the capital expenditure reserves that an investor is holding as a share of their net operating income as of September of last year. 28% CapEx reserves for office. paying those brokerage fees, paying the fit out for the assets, redoing the lobby, figuring out how to entice people to take space, that is expensive. It's second only to lodging, which we put in the bottom in the gray at 30%. By contrast, storage, one of the reasons we love it so much, CapEx reserves are 5% of net operating income. You just don't have to spend that much to keep it full. And investors have taken note of this because my clients need to know how they're paying the teachers' pensions, for example. All right, now I'm going to quickly move. Let's see how we're doing on time. All right, giddy up. I have 5 minutes. Quickly, I'm going to do one slide per property type. Office, 17.2% vacancy and heading higher through a combination of the fact that there is development taking place because those assets that have demand right now are brand new trophy assets with HVAC systems that make us feel less scared about being together, with open air places to get outside. Even in Chicago, there's demand for that. So there's development that's happening today, not typical in a recession, and then there's the demand that is shrinking. Do I believe the office is dead? No, I do not. Am I a boomer? So yeah, I'm used to going to the office, so take that with a grain of salt. But we are watching firms bring people back as they're trying to get ready for a challenging period economically. There'll be more of that. Office has a tough time ahead for the next 3 years, but don't count it out. I'm going to roll on to conversion. Let's just spend a moment on it. What's highest and best use for real estate is so different than it was 20 years ago. Allstate has been in it, was in this space since the 60s. Am I remembering that right? Now, its highest, best use is warehouse and distribution space. Meanwhile, there'll be conversion. The city is going to help get conversion of office to other uses happen in downtown Chicago, some of it affordable housing. That will be good for everyone. It's a great use, in my mind, of TIF dollars, and I look forward to seeing it unfurl in 2023. All right, retail. Here's my title. After a time in the wilderness, retail fundamentals are up. Probably better seen on this slide. The only line, these are vacancy by format, only line heading up, that's mall vacancy, which is, wow, 9.4%. If we could take this data and break it out to the A malls, the Brooks, versus the B and C malls that are heading for some other land use long term, we would see vacancy coming down. Just don't have that fluency with this, or that flexibility with this data. Meanwhile, vacancy down for neighborhood and community centers in purple, down for lifestyle centers in orange, and power centers, the lowest vacancy of all. Mike Mallon. And that's partly because we didn't just buy online during the downturn. We bought online and we picked up in store. And the spiking of costs for getting new customers and advertising costs went way up. That caused the unthinkable to happen. Stores, this chart is, more stores opened over the last couple of years than closed. There will be more store closures, but broadly speaking, retailers that never thought they would have a store are opening stores. And here are some of them for your perusal. Apartment, my colleague Mike is going to grimace if I don't do well with this. Let's find out. Apartment starts a downturn in pretty good shape. The occupancy, that's the yellow line, 97.2% as of the third quarter. There is a lot of space under construction though, and in the U.S. we tend to concentrate where new rented residential goes. And that means that you're going to see some concessions as the owners try to lease things up, particularly before winter comes. So rents are in good shape relative to a year ago, and some leases are rolling up to market, but expect some concessions, particularly in urban settings. Here's a little detail. Chicago shows up on the rent growth side in the gold area with 12.2% year-over-year rent growth as of the second quarter of last year.
That will start to soften if indeed we have a recession, but we again start this downturn in good shape. Lots of new construction, but we need more. You city planners, try to think about how to house your people in as inexpensive a way as possible. Say yes to development of apartments. It's great for, well, it's great for affordability. Mike, you had a stat in one of your charts that I didn't use for today that said that basically since 2010, apartment rents nationally have gone up something like 410%. That's why we have affordability issues. We've got to figure out how to house our people. Storage. What a story. This is looking at net operating income. Periods where it goes down, those are recessions. But it's only in the down moment for a shorter time, particularly compared with office or even industrial in some moments. Medical office, Mike's sector, again, so I'm going to not look at him as I talk. Vacancies, we're plotting in the lines, we're plotting vacancy for commercial office, that's the gold line, orange line, versus the green line, and that's the vacancy rate for medical office. It's not perfect. We had dentists that weren't paying their rent because they couldn't see their people in the spring of 2020, but it is among the most rock solid of property types, in part because of limited speculative construction and tenants that stay when their 10-year leases renew. Once upon a time, we were excited by that 2% annual rent increase you can get in your 10-year lease. Looks nothing compared to inflation in recent years, but it's still something, and it's part of the joy of medical office. Senior housing, terrible story during COVID. It has turned a corner. These are occupancy numbers. It's coming around for nursing care in yellow, assisted living in green, senior housing in is that black, and then independent living. All sectors are seeing a rebound, in part because of the aging of my generation and our parents. Single-family rentals, get to know this sector if you don't already. There are reasons why people might move into something with four walls out of a box in the sky when they've got kids and can't yet afford the school district they want those kids to go to school in. There's a lot of supply in the realm, but it's an interesting property type that suits the needs of millennials and may well suit the needs of a lot of baby boomers as well. All right, I'm going to end on climate change. The picture on the left is almost what was in the magazine I was reading. It was at about the same time Ian hit Florida, and it was an advertisement for vacationing in Florida, which this is not a knock on Florida. What a lovely place. I spent my early frequent flyer miles going to Florida, right? It's a lovely place. But it's a challenge place. And so I took the what if you were here and created the image of destruction on the right. Actually, Ian created the image of destruction on the right, as in Hurricane Ian. Migration patterns in the United States in recent years have been toward climate vulnerable locations. So the big climate winners, population-wise thus far, big population winners are Florida and Texas, both of which have gigantic challenges relative to keeping their population safe from flooding and particularly hurricanes. And so we're expecting at some point, as the true costs of a life in these beautiful but vulnerable locations becomes known, that we're going to see an unwinding of some of that migration pattern. Especially because the insurance costs are going to continue to rise. And there are those that are speculating that a place like Florida will simply only be affordable to Ken Griffin and his colleagues, right, that have the wealth to pay the insurance costs and the private jets to be able to help them leave so that they're not part of the long line. I'm digressing. A little crabbily, how about that? Florida is a beautiful place, but it's getting less livable and more expensive, and so there'll be some places that the halfbacks will go to, and that will benefit Asheville and Raleigh and maybe some Chicago. My brother's the only person I know that bought in Naples and then bought in Chicago and said, hey, that's my refuge. And that is one of my themes. Chicago should position itself as a climate refuge. It's got a lot of great attributes for that. Some of the elements of climate change that we're looking at, the top relates to all of the risks that are inherent in climate change that include the physical damage, the potential for insurance, premium repricing, or for the unavailability, particularly from households. Tax increases to fund the lifting of roadways and the preparation for inundation. This is where Chicago has challenges, right? The volume of water that can drop in a storm is just so much greater in an era of climate change than it was. Even with the deep tunnel, we still have flooding issues, and they're highly concentrated in lower income neighborhoods, and that's a crime. So, tax increases. Investment liquidity, we haven't seen it yet. On the commercial side, we're not watching people redline certain vulnerable areas. That will come. And if you need any reinforcement of this, just look at Jakarta. The capital of Indonesia is being moved to higher ground. Well, that will be an interesting story to watch, the value of the property that's being vacated. We can't defend all of our coastline. There will be an abandonment of the riskiest and least resilient locations. And then the bottom part of this chart relates to the regulatory side of things, which has just changed radically. Things like LEED, they're voluntary. We do that as developers, as architects, you help guide us toward a sustainable use in materials and thinking about the future. But those are voluntary programs. We're moving globally from voluntary to mandatory. And mandatory comes in a couple of forms. There are entities like the European Union that are mandating disclosure at the property level and at the fund level, if you're an investment advisor like we are, of what's the green profile of your property, of your fund. There are places in the world that have put in place energy performance certificates. They've been around for 20 or 30 years across much of Europe, but now there's more teeth to them, including the fact that right now in the UK and France, I believe it is, if your property doesn't, look at that rating scale on the bottom right, if your property and its energy performance doesn't hit in the top 3 levels of this, you can't lease it out and you can't get a mortgage. Where are the lawyers in the room? That sounds like a taking, right? And it's leading to stranded assets, they're called. Assets that it's too expensive to bring them up to the code effectively at the rates that you would get for leasing them out. Buying opportunity for those in the right location, tragedy for those in the wrong. Then there's Local Law 97. That's New York City's approach to this. It's a law effectively on emissions. It's not about the building standards to which your asset was built. It's about how much is emitting greenhouse gas emissions from your property, and there's a tax on it. Recent development, One Bryant Park, is probably 5 years old, no doubt LEED Platinum or in that vein, that's facing a $2.6 million fine that relates to the fact that the tenants include some trading firms that have overnight trading, so their energy use is high and the grid is dirty. In New York, hence, in emissions, a tax effectively on emissions. And this is just the beginning. As municipalities try to get the owners of properties to focus, the developers to focus, and as well to create pools of money to help pay for the infrastructure changes that climate change is creating. So a lot that's going on. With that, let me look at the time. I can stay for 10 minutes of Q&A. So first let me say I'm so sorry. I booked this and then I got invited to a conference I didn't feel I could miss. So I apologize for this. And I'm sorry for racing through this breathlessly. It's been a pleasure to talk with you. I hope I've hit on some of the things you came here for. If I didn't, Ruth Warma isn't here to give me a question I can't answer, but I bet some of you are. That's funny because some of you have seen that happen. Anybody have a question, a topic you were hoping I would cover that I didn't? Yes, Steve Vance, the Ruth Warma potentially of today.
Do things that happen in India affect your research or things that you would have put in the chart if you had more time or space?
Oh, so thank you for that. Well, development in India, manufacturing in India is meaningful for all of us. Their climate issues are meaningful for all of us because they're going through industrialization at a time when people care about their emissions versus what the US got to do during the Industrial Revolution, which was immense pollution. So I'm sorry, that's probably a dead end I've just gone into. We are not investors in India. It's got big issues that it's been looking like the next developing country to invest in for 30 years of my life. I'm not sure it's there yet, but this could be the moment as the anti-China as the alternative, well-educated population. So yeah, it should be on Mike Carney's to-do list to understand India better. Yeah, Mike just pointed out, still growing population versus China's is not. I hope that got to something of what you were looking for.
So I noticed that Apple used to be 100% China
Correct.
manufacturing, and now they're broadening it, so now they're only 95% China,
Yeah.
and like 3% Vietnam, 2% India.
Absolutely. That is going to happen. The way it's going to intersect most with what I do is it's going to affect demand for warehouse space in Norfolk and in Savannah and the east coast of the U.S. Other people, it's worth figuring out, an immensely complex country like India, worth figuring out. We haven't been able to do it successfully. Others have come in and left. It's just a complicated setting, but yes, manufacturing will grow in India, and that will affect where we keep our clothes are from, and yeah. Anyway, so look at it from a port's perspective. Thank you. Helen Kessler.
So you talked about retail, and I can't help but think about Michigan Avenue and State Street.
Sure.
And so, you know, those are like open malls, but they're not doing so well. So
Yeah. Give them time, I think. So everybody heard Helen's question, the stumper on retail and the future of retail. I say this, understand, I remember going to Oak Brook when it opened. I was at Randhurst when it opened. I didn't go there for the closing. Anyway, I love physical retail, so take that with it. I'm standing next to keyboard. This is such a pleasure. He could answer this question better than I do think that what we saw come out of COVID was a recognition that there's something pretty magical that can happen in spaces where we come together. And there's some value to being able to see the merchandise, touch the merchandise, experience the merchandise. I do hate the experience word, but to experience the merchandise. What's challenging for State Street and for North Michigan Avenue is their sheer length. And it takes a while for retailers to move into somebody else's format, and you can't quickly fill up those vast spaces that have been left behind. But I think give it time. These are places that have remade themselves several times over. Part of State Street's coming back to life was a recognition, make the bottom part of it institutional, just help change uses to other things that are complementary to vitality. I think that will happen for both those places. More people living in the areas adjacent is also part of it. The Target on State Street is a function not just of office workers, but the sheer number of students and people living nearby. So give it time. I think we're moving in the right direction from a city approach to crime perspective, because crime is an element of this. Anyway, I hope that somewhere gets somewhere in here. Yes?
You can't leave without commenting on the political uncertainty of Chicago and how the various candidates may affect our future.
Oh, for God's sake, sure I can. Did you hear that? Did you hear that? It was, you can't leave without addressing. Yes, I can. I'm a political scientist that didn't predict many of the elections that changed things recently. So I'm not sure I feel like I'm on particularly solid ground. What I know is, you mayors that are in the room, village managers, it is a hard time to govern. And governing in an environment in which we're losing high-income households to other places, either because of the lure of the water and the warmer area and the lower taxes, we are not well positioned against that lure. And that's going to be the negative. The positives of Chicago are remarkable, and they include the academic institutions that many of you graduated from or that brought you here to begin with. That just can't be matched. Anyway, so I'm a believer that it's an immensely difficult time to govern, and I applaud those that want to try. And I think I'm just going to stop there. I'll think about that at 36,000 feet. How about that? One more question.
I've got a question for you about the office to residential conversion
Yeah.
that's being looked at
Yes.
in places like our fair city and
Yes.
other, major urban centers. How do you see that changing the dynamic of your kind of retail chart when we go from
Okay.
land uses? And what is there a future for that?
Well, first I'll say it takes a lot of conversion to bring a place from dead at night to lively. And I say that because I was in Dallas for ULI in the spring. I stayed in downtown Dallas near the convention center, not a place I'd ever been before, because when I've been to Dallas, I've stayed in the suburbs, right? Not wanting to, but because. And I looked out the window and I could see significant visible signs of office conversion to something else. There were swimming pools on roofs, there were balconies, all evidence of residential conversion. And that being said, the place is still dead at night. So it takes a great deal. But look at the South Loop. The South Loop was our first major instance of significant residential conversion in Chicago, long before River North. It was the beginning. Printers Road, Dearborn Park, not conversion, but ground up development. A nice complement, that mixture. Because what Dearborn Park did, I would contend, is it brought mass to complement the adaptive reuse that was happening along Dearborn Street and other parts of Printers Road. You do need a lot of mass. So we've watched it do wonderful things for the city. My contention about why Chicago's office space as a share of the metro has long been that there were places for the CEOs of firms to live near to their office. There were places for workers to be able to live in walking distance from the office. It was this wonderful mixture of price points. That is what Chicago is, and we can help augment that. The Loop is a monoculture right now. It's dominated by office and vacant retail on the ground floors of buildings off State Street. And we got to change that. Google, bless them. They are bringing the color back to LaSalle Street. I'll just tell you, I was part of the LaSalle Street Technical Assistance Panel for ULI, looking at the future of LaSalle Street. And there were people on the panel that are astute, but they hadn't ever been in Chicago when the traders were out at lunch, right? And you saw people wearing very odd outfits and a lot of color. And that's what Google could do to the north end of LaSalle Street. That was a huge compliment to the efforts at stimulating residential conversion. One final comment that you know better than I. A 1 million square foot building is not going to get converted to residential. It's just too big a risk. It's going to get converted to a bunch of different things. I think most of the conversion that's going to happen is going to be of smaller buildings in streets adjacent to LaSalle Street rather than the big buildings. But in the process, they can help firms say, hey, I want to be here because there are places where my people can go and have lunch, they can have dinner nearby, and we can help make that happen on LaSalle Street. I would urge you all to, as things open up on LaSalle Street, visit them, vote with your feet, help support them in the way that we've helped support the retail in our communities. We've got to do that for LaSalle Street as part of the transformation. Is that a good way to end, everybody? I hope so. Thank you all so much for coming.